USAA Investments tells us what top stocks to invest in to ride out a choppy market. And Trent Wagner's at the CME dealing with all things commodity-wise and currency-wise, which is where I want to start, Trent. The euro. How would you trade the euro right now?
Well, I think since we had the Fed statement mid last week, that narrative flipped with that strong U.S. dollar short euro trade. But a lot of it, I believe, was some short covering. Obviously, that communication from the Fed was much more dovish and translated as such by the marketplace. But the reaction, in our opinion, is probably a little overdone. As we move the focus from that Fed statement back to the ECB and back to central banking policy, it just doesn't look good for the euro. And we would certainly look at this as an opportunity to short the market. We're 5 full handles off of the lows from earlier this month. And I just don't know that we're going to get many of these opportunities given the QE program that's firmly entrenched over there and a Fed over here that looks likely to tighten, if not later this year, sometime early next year at the latest.
Well, you know, that's interesting, Michael, because we just got those comments from Fed Chair Yellen, and Dan Brew just joined me a few moments ago and said, you know, it may not be this year that we see interest rates go higher. You know, language or not, they don't really have a reason yet to truly hike rates.
You know, they really don't, and that's a good point. So, you know, one of the things we see with the markets is we know the rates are going to go up at some point in time, but they're not just quite ready. So whether it's this fall or next spring, you know, that conversation is going to go around the table. I think when it does happen, what we know for sure is overall with the markets, we've still been in that sideways trend. So we want to be cautious as we're moving forward in engineering portfolios to make sure we're okay, regardless of what does happen whenever they do raise rates.
But, Bob, we are chugging ahead, and just barely, we should say. We got the growth rate today, 2.2% growth rate is pretty mediocre. On the other hand, it's about twice or more than twice what they have in Europe. So compared to other economies, our economy seems to be doing well enough, so perhaps they'd be okay with a rate hike.
Correct. I mean, we have been doing better than Europe for quite some time. I do think the markets could handle gradual rate increases fairly well. I think the evidence, past evidence, suggests that that's the case. But I'm in agreement with Michael. I don't see the Fed acting this year at all. If they do, it would be late this year.
Yeah, Trent, no one seems to be listening to what Fed Chair Janet Yellen says. I mean, it's like nobody believes her at this point. But I will say, I do want to look ahead just real quick. We've got the big jobs report for March coming out next month. And Trent, you know, with what we're seeing with the energy industry and all the pullback there, job losses, I'm wondering if this is going to be a really rough report. Oh, and by the way, the markets are closed next Friday when the report comes out.
Yeah, I mean, the report coming out on Good Friday, that's always an interesting dynamic. With respect to the job market and the labor market, from a standpoint of looking at it through the lens of the Fed, job creation really hasn't been the issue. And I know we are losing some jobs in the oil sector. And the bigger problem with that is, up to this point in time, and we've had crude down over the last few months, that's not necessarily new information. And essentially, from a creation standpoint alone, other areas have picked up the slack there. The problem is in the participation. We haven't had that black eye of these reports make any improvement whatsoever on a sustainable basis. And that's one of the main data-dependent issues that the Fed has pointed out. They want wage growth, they want participation. So when you have big money jobs in the oil industry being replaced by jobs in the retail and service sector, it doesn't necessarily translate to that data that the Fed is looking for to justify a rate hike later this year.
Well, Mike, let's stay on oil. Let's talk money and oil. Oil is down 6% today. I know you like Occidental. Today would seem to be a good day to buy with oil down 6%.
Yeah, I think so, David. You know, I mean, at the end of the day, it's not going to stay down forever. And also what we do know is,
particularly, forgive me for interrupting, but particularly in light of what's happening in the Middle East right now. I mean, good Lord, if Saudi Arabia and Iran go at it together, you know prices are going to go up.
They definitely are. And not only that, even if that doesn't occur, you know, we're in a situation where we're getting ready to enter the summer season. We also know that the inflows at refineries have upticked to the tune of about 136 barrels a day more over the last couple of weeks. So that's showing a little bit of sign that the pricing, as far as the need, the demand, and all that, is going to overflow through the pricing of stock. So, yeah, you could go out and buy Occidental if you want to kind of do a play. They're a big company from Houston. Or if you want to take a little safer route, just buy an index. But I think over the next 3-4 months or so or more, we're going to see a little bit of an uptick. And is it now time to get in? I think it's okay to dip in the water here and there. Absolutely.
Bob, you know, one of the companies you like, I think this is interesting, is Seagate Technology, STX, as well as some other picks. But Seagate in particular I find intriguing in the current environment. Why do you like it?
Yeah, I mean, it's taken a beating in recent weeks as a number of companies that are tied to the, have some tied to the PC end market. But there's a big trend in big data and the storage needs that come with that. So, I mean, this is a huge, unstoppable trend. And Seagate, you know, provides the equipment that will help companies in terms of storing massive amounts of data. We're seeing more and more streaming services. That just means more data. So Seagate provides these high-density disk drives to service that market. We see modest but positive earnings growth. And the company has a great cash return to shareholder policy. Yeah. So the company's buying back shares, and it yields about 4% right now. So I think it looks very attractive.
Hey, Trent, just to show I can argue any side of an argument if need be, after arguing that interest rates are going to be hiked up, let's just talk about what's happening to overall interest rates, because we have the 10-year down below 2% again. It looks like the markets are betting on no rate hike, correct?
Yeah, I would say that is the case. And, you know, when you look at what's gone on in the Treasury markets over the last 15 months or so, really since the beginning of 2014, I mean, almost everyone came into the beginning of last year thinking rates would be rising, and they've done anything but that. It's been the exact opposite. And a lot of that isn't just what's going on here in the U.S. with our central bank, but it's artificially suppressed rates around the world, specifically in Europe and Japan. And the strength of the U.S. in general relative to these other places, if you're looking for fixed income yield, the fact that the U.S. is where it is compared to like products around the world, I think it's going to keep a firm bid in the Treasury markets. I think we're going to see, regardless of what the Fed does later this year, I think we'll see the 10 and the 30 6 months from now even lower than where they are today.
Holy cow.
Wow, Trent Wagner, what a prediction.
That's what Horowitz says, by the way, too. Todd Horowitz says as well.
Michael Wall, Bob Landry, thank you very much.
Good stuff,
What was
guys.
that, David? You can argue both sides of an argument?
If necessary. When it comes to interest rates and the Fed, absolutely. Who knows what they're going to do?
Line of the day. Guys, thank you very much. Appreciate it. All right, well, news.